Hey everyone! Today we're talking about a beginner's guide to real estate investing and why you should be using holding companies to protect your money from tax so you can do more with it by investing it instead. This whole interview was pretty long, so we split it into 3 parts, and this is the first part. In the second part, we go into whether you should be investing as an individual versus as a company, and what loopholes you can take advantage of. And finally, in the third part, we go into if the famous BRRRR strategy, short for buy, renovate, refinance, and repeat strategy that is popular in the US, also works in Spain for building wealth in real estate. The links to those videos I'll of course be posting in the description. All right, now enough of me talking and let's get to it. Hey everyone, thanks for making it to the interview. Today we'll be dealing on the topic of real estate, and here we have Julian Garcia joining us again. So thank you so much, Julian, for joining. I hope you're happy to be back.
Everything is well. I'm very happy to be back here. Always happy to talk to you and to speak about some tax issues.
Fantastic. Today, as mentioned, we'll be focusing on real estate. So maybe we'll just kick it off with the first question that generally people are thinking about is when it comes to buying real estate in Spain, what are the tax obligations that people should know about before making the decision to purchase? So maybe a little bit more generally, what's, let's say, a beginner's guide to tax for real estate investing?
Exactly. So very first thing is the transfer tax that needs to be paid here in Spain. In every region, it needs to be paid this transfer tax, and it depends on the region that the property is located. So if we are talking, for example, in Catalonia, which would be Barcelona, for example, transfer tax, it would be 10, 11%, depending on the amount. If it would be in the Balearic Islands, which would be Mallorca and Ibiza, then we would be around 8 until 13%, which is the highest tax rate in the Balearic Islands for luxurious properties. If we would be in Andalusia or Madrid, then it's around 7%, which is quite good. So it depends on the region that the property is located. So every time you want to buy a property, you need to take into account the money that you need to have, let's say 400,000 euros, plus the transfer tax, which would be around 9-10% on average. However, there's always the possibility to pay the VAT. Most of the times, to pay VAT or to pay transfer tax is not a decision that remains on the people's side. It is just something that is stated by law. So if we are talking, for example, about the new property or about the property that was completely renovated, then the one who buys the property needs to pay the VAT. The VAT plus the notary tax. That there's like a notary or registered tax that comes together with the VAT. VAT, if we are talking about a property where you can live in because it has a certificate that allows you to live in, it's 10%. If we are talking about any other property, let's say, for example, a store, a property where you cannot live because it does not have this certificate for living, then it's 21%, okay? Plus this registered tax, which is of around 1.5%. So if someone would buy a brand new property just to live in, or where it is possible to live in, then this person should pay 10% VAT plus 1.5% this registered tax, all right? So this is more or less how it goes when buying a property. And very important, you always need to buy this tax. So either you buy VAT or transfer tax. There is absolutely no way to avoid paying one of these taxes. All right. So always keep on mind that. However, we will see in a few minutes maybe a few strategies in order to optimize this taxation. But in any case, just keep in mind you have to pay VAT or transfer tax.
Okay, got it. Then I guess moving on to the next question, what are the actual differences between if I'm a resident or a non-resident? Are there any tax differences for real estate purchasing in Spain?
For the purchase itself, it is the same, all right? It doesn't matter if you are a tax resident in Germany, for example, or in Italy or wherever in the UK or the US, you always need to pay either the VAT or the property tax. If we are talking about people that are non-residents in Spain, then we should pay more attention into the income tax. So, okay, first step is to buy the property. What happens after buying the property? Which taxes do I have to pay in the future, for example? There we can see that if you are a person that is resident in an EU country, then you will need to pay taxes on this property. If you use it just for yourself, then you would need to pay like a self-use tax, which is a very low tax and not a big issue. Let's say 1,000 or 2,000 euros a year. So it's pretty affordable. And if you want to rent this property, which is also a big issue, many people buy properties here in Spain, they live outside of Spain, and they just want to rent the property. Then, if you're an EU resident, you will just take all your income minus the costs, and the difference is the profit that you get, and this profit will be taxed with 19%. And now here pay a lot of attention because this is super important. What happens if you are outside of the European Union? Let's say you are a tax resident in the US or in UK. All right. What would happen in these cases? It applies the 24% rate. And what is a very key factor is that all the expenses that you have, they cannot be deduced. It makes a huge difference. So because imagine you have a property, you rent it for 2,000 euros. So it would be 24,000 euros a year. Imagine if you would have to pay 24% of 24,000 euros, or if you would be, this would be the case if you are a tax resident in the US, for example, outside of the European Union, or if you would be a tax resident in Germany, for example, inside of the European Union, you would just pay 24,000 euros minus all the expenses, let's say 8,000 euros expenses. So you would just pay taxes on 16,000 euros on the real profit, and you would just pay 19% instead of 24%. So here we need to pay attention on people that are from outside of the European Union or inside of the European Union. If you come from the US, for example, or from Brazil or UK or whatever, I would recommend you to get a Spanish company. Why? Because Spanish company is tax resident in Spain. Yeah, it's a Spanish company, so it would be taxed with 23, 25% the corporate tax. But the most important thing is that you could deduce all the expenses. Yeah, so this is something to keep in mind.
Okay, got it. All right, now moving on to the next thing. What kind of real estate related deductions or tax breaks are there in Spain? Could you give any examples of different ones from different autonomous regions here in Spain?
So when buying properties, there are some tax exemptions in the transfer tax, for example. Here in the Balearic Islands, if you are under 36 years old, and if you buy a property that is 270,000 euros worth or less, then you can just pay 2% of transfer tax. So instead of paying the general transfer tax, which would be 8 until 13%, you would just pay 2%. So every single region in Spain, there are 17 regions, can decide how they manage the transfer tax rates. So in this case, we should analyze every single region where the property is located in order to say if there's any kind of tax reduction in the transfer tax or not. Just as an example, this one that I said about the Balearic Islands, which would be 2%. And there was a new one here in the Balearic Islands where you would just pay 0%. You would need to be under 30 years old and a few more requirements. And you should have lived here in the Balearic Islands for the last 3 years and a few more requirements. But if you fulfill all of them, then you would just pay 0%. This is a very interesting issue. Yeah. And yeah, that's how it works. So we should just analyze every single region. But of course, there's always some kind of gaps or advantages that we can take profit of.
Quick question, actually, of some people have mentioned that to avoid sometimes capital gains or dividend tax, or when they're bringing money that was sourced from outside of Spain, they can sometimes get a tax break for reinvesting that money back into Spain in the form of real estate. Is there anything that you're aware of there that is possible?
So here in Spain, if you buy a property and you live in this property during at least 3 years without renting the property, so just for your own use, then you can just sell this property without paying any taxes, without paying any capital gain tax. If you reinvest this money in a new home, in a new main property. So this is the main issue. Or if you are above 65 years old, you don't need to reinvest the money. If it was your main house, you just sell it and you do not pay taxes at all. So these are like the two ways in order to avoid to pay the capital gain tax.
Yeah.
If not, here in Spain, related to property, there's always this need to pay the capital gain tax. And
Does,
if you hold the property through a company, then there's always the corporate tax, which is around
yeah.
to 23-25%.
Okay, got it. Does it also apply to if the property that I'm initially selling, if it's outside of Spain? So, if maybe say I'm coming from the UK or Germany, does a 3-year living period apply if the property is outside of Spain?
Yeah, it would apply if it's outside of Spain. Let's suppose you have been living in Germany for in a property for the last 3 years or 4 years, for example, and then you move to Spain. Yeah, and then by being here in Spain, you sell this property that is located in Germany. Then, due to the fact that this property was your main house, your main property in Germany where you lived in, then you can sell it, and then if you reinvest the money here in a property in Spain or in another country that is going to be your new home, your new property, then it is also tax exempt. So
Okay.
this property that you're going to sell needs to have been your main house in order to be able then to sell it tax free. Yeah,
Okay.
that's the key point. So of
How
course it
do,
would apply for people who, regarding your question, for people who comes from abroad, they just move
yeah.
to Spain, and then after that they sell the property. They can sell it without paying the capital gain tax.
Actually, in terms of like procedure, how do I go about mentioning this to the Spanish government? So, like, I sell the property, and then I have that money. Do I then have to then have to file a tax return in Spain and then mention all these things? And do I have to provide documentation showing that I was living in that property for multiple years, or do I only tick a certain box that I'm exempt, and then they ask for the documents afterwards?
Exactly. Here in Spain, it applies the general rule that you can file whatever you want to. All right. So I can file 1,000 or a 10 million in the tax
Mhm.
declaration. I can say whatever I want to. From that point, the Spanish tax agency has 4 years to prove that. So in your
Okay.
income tax declaration, that needs to be filed always between April and June from the next year, in April, June of the next year regarding the last year. And there you need to file and to indicate all the incomes that you had. All right.
Okay.
So in your case, if you consider that this sale of the property was tax exempt,
Hmm.
it's okay, it's perfect. Yeah. You can just do it. So no worries about that. But if you get a tax inspection, of course, you need to have all the documents in order to prove that this sale was tax exempt. So according to the Spanish tax law, every person who wants to apply for a right or who thinks that has the right to apply something has also the burden to prove that. So the person who needs to prove it is the person who is applying the right. So in this case, if you are applying the right to sell with the tax exemption, you are the
Hmm.
one who needs to keep all the documents that proves that that property was your main property. For example, if you can keep the electricity bills, the water bills that shows that there was someone living there, if you
Yeah.
can keep, for example, the track record of the payments of your bank card that shows that you have lived in that area, all right?
Hmm.
So these are evidences that shows that you have lived in that area and that this was your main property. It would
Okay.
come to a conflict maybe or to some situations where the taxpayers can also take profit of that. If you have, for example, let's suppose you have a few properties in the same area, yeah,
Hmm.
and that these properties has been rented, yeah. Of course, there are some consumptions in electricity and water, but you don't really know who was living there. Was your brother living there? Was your friend living there? Who was actually living there? And in this case, you could just say, okay, I'm going to sell this property and I'm going to say that I was the one who was living there. And due to the fact that the properties are very next to each other, You can
Yeah.
still prove it. Yeah, of course, it would be a trick. Yeah,
Hmm.
right now we are here on camera. I'm just saying that you need to do everything according law. But just for my experience, this is something that many clients have done it.
Okay. Interesting. But of course, for official purposes, everyone's doing things right by the law.
Exactly.
But okay, interesting. Then I guess for people who want to invest more aggressively into Spanish real estate, what are some of the best strategies to do it in Spain? I think you mentioned you were teasing some of those strategies earlier.
Yeah, definitely. Here in Spain, there's this special tax regime. Companies who buy at least 8 properties, and who rents these properties for a long-term period of time.
Hmm.
So if you really have in mind to buy a lot of properties here in Spain, I would recommend you definitely to buy at least 8 properties. Yeah. So if you are having some doubts between buying 5 or 6 properties, I would maybe recommend you to buy properties that are maybe a little bit cheaper, so that you have a little bit more money just to buy 8 properties instead of six, for example.
Oh,
Yeah.
okay.
And in that case, you would just pay 15%, 15% in the corporate tax instead of 23 or 25. So it actually makes a huge difference just to pay 15% on the profit that you get of renting these properties. And that seems like a very good idea or option that I would recommend everyone who's planning to invest a lot of money in Spain.
Okay, got it. I was just looking at the doc now of questions, and there was one question that I was actually really interested to ask you, basically about a type of company in Spain that where you're able to that a company that the only existence or purpose is supposed to be in real estate purchasing, where you could take
Mhm.
advantage of a 0% corporate income tax rate. Do you know of anything like that in Spain?
Yeah, these companies are called in Spain SOCIMIS. SOCIMI, which means Sociedad de Inversión Inmobiliaria. Exactly. The translation would be REIT, which means REIT, it is real estate investment trusts. So this is an idea that became very common and popular in the US, especially, and also in the UK. And it is basically a vehicle of inversion of investments, excuse me, just for many people. Advantages, it sounds great because you pay 0%. That's definitely true. You pay 0% in corporate tax, and you have a 95% tax exemption in the transfer tax. So actually
Okay.
you don't pay almost nothing.
Okay.
But what are the cons of this type of companies? That they need to be in the stock market, which
Ah, okay.
implies a huge amount of regulation, and the money that is earned by these companies needs to be distributed to the owners, which means that even though the company is not paying anything for the corporate tax, the owners will pay for that benefit, yeah, in their income tax. So, just to give you a few information about this, here in Spain there are maybe 60, 100 of this type of companies. In Germany there are maybe, I don't know, 10 of these companies. So
Mm-hmm.
maybe I'm exaggerating, it's not 10, it's 100. But I mean,
Mm-hmm.
it is just a few companies that exist under this type of regulation, just because,
Okay.
as I said, it needs to be in the stock market. There needs to be a minimum of free float, which means stocks that really needs to be exchanged. So
Mm-hmm.
this is not an option, for example, for a family office, yeah, that wants to invest 100 million euros,
Yeah.
because the stocks needs to be exchanged. So yeah, I mean, if you are an investment fund, then it may be interesting to have
Okay.
one of these companies. But if not, if you are just a wealthy person or a family office that needs to invest 50 or 60 million euros, then this is not the right way.
Got it. Okay. I have no clue why I didn't make Again into the doctor because I remember seeing this somewhere and I thought, okay, this definitely
Yeah,
needs to be.
definitely. I mean, if you just take a first look at the advantage, it sounds great. Definitely the first time that I took a look at it, I also thought, wow, this must be crazy. But then when you take a look and you talk to other tax advisors and lawyers about this, and then you realize that there's almost no companies
Yeah.
like that, then you realize that it doesn't make sense in the end.
Yeah.
Yeah.
Turns out it's not so easy to get a quick company into the stock market.
Exactly.
Does it need to be actually in a stock market in within Spain to get the 0% corporate income tax, or would it need to be, or can
The
it be any stock
European
market?
Union. Yeah.
All right, got it. Then back to the original set of questions. So where were we? So we talked about the best strategies to invest aggressively into Spain. You mentioned, the moment you go for 8 properties, you can get the 15%. Would you say that this is pretty much the best strategy to go for? Are there any other sort of popular but good strategies?
I would say this is like the best strategy to go for it because it is pretty simple. Yeah, you just
Mm-hmm.
need just a standard limited company, a Spanish
Mm-hmm.
limited company, which can be constituted in 1 week, let's say, or in a few days.
Mm-hmm.
And then you just need to buy the 8 properties, and that's it. So basically, it is pretty easy to prepare everything and you just pay 15%. The problem would come if you would like to get the money out of the company because then
Mm-hmm.
you need to pay the dividend tax, yeah, which is around 25%. So if you have as a strategy just to buy a lot of properties to generate a lot of money and you are able to just let the money in the company, maybe you can take a little bit out, but
Mm-hmm.
basically let all the money in the company, then this is the best strategy. You just pay 15% and that's it. But if you want to really take the money out of the company, then I would maybe recommend you another type of strategy. Yeah, I would recommend you maybe to buy it as a direct person.
Mm-hmm.
Why? Because you get 50% off in taxes if you rent the property for long term, and you can apply this 50% off from the very first property. You do not need to have 8 properties. So you just with one property, you just rent it long term, and you get this 50% off if you're a tax resident here in Spain.
Yeah.
And if you are a tax resident outside of Spain, let's suppose in Germany, for example, or in Italy, then you would just pay 19% taxes. And the money would be direct in your pocket. So there is no dividend tax. Yeah.
Okay.
So this is something to take into consideration if you are what you really want to do with this money. If you really need to use this money for your private issues, or if you just can let the money in the company. This is one very big thing
Mm-hmm.
to consider. And if you're living in Spain or outside of Spain, this is the second thing to be considered in order to make the best decision.
Two questions I have. One, what is the actual definition for long-term rental? So 6 months, 12 months, like at what point do I have to have a rental contract with my tenant to apply for this?
1 year.
1 year. So, okay, so it needs to
Yeah.
be at least 1 year with the tenants. So
Yeah.
I guess people who do like Airbnb rental business, it doesn't apply to this. So it's
Doesn't
usually short
apply.
term.
No.
Ah, okay,
European.
yep. Second question, and we get this from a lot of people actually. When it comes to the whole idea of leaving money or profits in a company and just letting it accumulate there, like I don't know, in the previous session we were talking about, having a company in Andorra and you just let it accumulate there and you only take a minimal amount. A question that a lot of people come up with, whether it's a company anywhere, whether it's in Estonia or in Spain or in Andorra, is why would I ever want to just let money accumulate in the company if I know that I have to take it out and pay dividend tax or pay income tax personally? And if I know I have to take it out at one point, why not just take it out immediately? What's the benefit of letting the money accumulate in the company? What can I do with that money if it's just sitting in the company? So, do you have any thoughts about that?
Yeah. So here's the thing. It really applies very well for people who are very wealthy. Let's suppose you have 40 million euros in wealth. Yeah.
Mm-hmm.
And you need to invest the money. Of course, you are not going to let 40 million euros in the bank account. So, but you really, how much money do you need to live? 100,000 euros a year, 200,000 euros a year? I mean, unless you want to party every day with huge expenses, with 200,000 euros a year, you could have a super good life and you don't
Mm-hmm.
need to worry about nothing. So, would you do with the rest of the money, right? If you have 40 million euros, let's suppose you invest 10 million euros in the stock market or 20 million euros in the stock markets, and you obtain a year in dividends, let's say just 3%, but 3% of 20 million euros, that's already, how much is it? 600,000 euros, right?
Mm-hmm.
So with this money of the dividends of the stock market, you have more than enough. So what would you do with the rest of the 20 million euros that you have? You just invest it, but all the money that is going to be generated, you really don't need this money. So
Mm-hmm.
in these cases where you are really wealthy, where you do not need this money at all, then it makes sense to have this type of structures. Yeah, because as I said, you are not going to let the money in the bank account, so you really need to invest it. But you don't want to invest it in the stock market, maybe because you already have a lot of money in the stock market, or maybe because it is a little bit unstable. So what do? You have bank account, stock market, real estate. These are basically the three places where you can have the money. Of course, cryptocurrencies is another place, but I put cryptocurrencies together with the stock market, yeah,
Mm-hmm.
because it's a place where the volatility is quite high, yeah. So you never have the security that you would have with real estate, yeah. So these
Mm-hmm.
are basically the three fields where you can invest money, and of course your own company if you're running out a business in your own business, yeah. But if you have already money in the stock market, if you are already running your own business, you are earning a lot of money, but you
Mm-hmm.
still have 20 million euros to invest somewhere. Yeah. And you just say, okay, let's have something stable. I invested in real estate and you don't need this money. Then in this case, it makes a lot of sense to have this type of structures just with a super low taxation. You just let the money there and then let's see what you do in the future. You can maybe then, if you need the money, but you don't want to pay the dividend tax, you can maybe borrow the money from the company, because loans, they are not tax obliged. So you just
Mm-hmm.
can take 1 million euro out of that. You just say, okay, this is a loan that is going to be paid in the next 30 years. Yeah. You need to set a tax rate, let's say a 2% tax rate, but then you can use this money and you can
Mm-hmm.
also pay the loan with the own loan that you received. Yeah.
Yeah.
So actually there's a thing that you can play with that money without paying taxes.
Okay.
Or if you want maybe to have a new company, you can just create a new company under this company who has the properties. Yeah.
Mm-hmm.
And then you just put the money of this company in the daughter company, mother company, and daughter company, and you can just run a business. And the money that you put in a daughter company, it is tax exempt. So, and then you can do other stuff. Yeah, you just buy a holding structure with the holding company with the properties maybe on top, and then you have other companies down there. So there's many ways to structure your wealth, but definitely if you do not need the money to live, I would
Mm-hmm.
recommend you to look for the optimized taxation.
Interesting. Okay, I think it's the first time anyone's ever answered the question of why should I just keep the money in the company? Because most people are like, okay, maybe I should take the money out of the company so I can then directly invest into things, like you mentioned. So maybe it's better to then invest just via the company rather than via myself.
Exactly, definitely. That's what I always recommend. If you get the money with
Ah,
the company and then you want to invest it, do not take the money out. Just invest it directly with that company. Just create another company down there.
yeah.
And then you have the mother company, which is the holding, and then the daughter company. All right. Or you can also create another company, a daughter company, that does not depend from the mother company but directly from yourself. This could be
Okay.
another option. Let's suppose, for example, you have an operative company on top,
Mm-hmm.
and of course the companies that are active and that are not related with real estate, which is quite secure, let's suppose are a real business.
Mm-hmm.
This real business is very important that does not have the function of holding company. All right, because if something goes wrong in the active company, then
Mm-hmm.
all the daughter companies would be infected. Yeah. So what I would recommend in this case, if you have the operative company, just create another company, all right, maybe on top of that or maybe on the side of that, so that if the
Okay.
active company goes wrong, the other company is not infected by this active company. All right. So the idea is always that the holding company is just a company, as the name says, that just holds other companies down there, yeah, and that does not do anything. So you have the holding company on top, and then you have maybe 6 or 7 companies down there. So if one of these company just goes wrong, everything, then it doesn't affect to the other 6 companies. Yeah. So, but the holding company idea is that it remains always clean. Yeah, without any kind of
Okay. We
exactly.
heard this in a different episode, I think, with a different advisor. Was it that the holding companies in Spain get a reduction of 95% of the taxable income? Was it that still apply here?
Yeah, that also applies in many of the European countries.
Mm-hmm.
95% tax exemption of the amount that is given through dividend or through the sale of the daughter company. All right.
Mm-hmm.
So let's suppose, for example, the daughter company has a profit of 100,000 euros and just sends this profit to the
Mm-hmm.
shareholder, which is the holding company. Then from this 100,000 euros, 95% they are tax off. They just get off the equation. So it only remains 5,000 euros to be taxed with the standard corporate tax. So in the end, the final taxation is of 1.25%. So a little
Okay.
bit over 1% is the final taxation by this dividends distribution.
Okay. One question about what you were talking about earlier if I have the operative company and I create a daughter company and I transfer money from there to there to sort of make it tax exempt and then I can use that for investing. One question, if like in the first when the year I set this up, I have 100,000 in retained earnings that's sitting in
Yeah.
my opco, in my operative company, like my original business, and then I create the new daughter company and I transfer the 100K to the daughter company. Next year, I have now a new 100K amount that's in the opco. Can I then in that tax year transfer it again to the daughter company, or do I have to create a new company? Does it work only one time, or can I transfer it every year to the same daughter
Every
company?
year you can create unlimited companies. So there are many holding companies that have maybe 100 companies hanging down there.
Okay.
Yeah, so you can have as many companies as you want to. But always keep in mind that if you want to have new businesses, the operative company, the real operative company, does not need to be the holding company. Because imagine, for example, you have the operative company up there,
Yeah.
and now everything is going super well. You are obtaining millions of euros, yeah, and then you create the
Mm-hmm.
daughter company down there, yeah,
Yeah.
and then you put the money from up to down, yeah, and
Mm-hmm.
then with this down company you just buy properties, all right.
Yeah.
And all of a sudden there's a crisis, financial crisis or whatever, and everything goes wrong up here, yeah,
Mm-hmm.
then all the people who have the right to get the liabilities from this operative company, then they
Yeah.
are going to ask for these daughter companies with the properties because it is in the balance sheet of the of the mother company. But if
Yeah.
we just switch it, yeah, and we just say, okay, here's the operative company, which is the daughter, not the mother, and the mother company is the one who's stable. If
Mm-hmm.
something goes wrong here, this company or all the people who have the right to ask for the liabilities of this company, they just
Yeah.
can go down. They cannot go up because due to the fact that it is a limited company, the shareholder does not respond with the capital of the shareholder. Yes, so
Yeah.
everything that's in the holding or in the other daughter companies just belongs to the holding. So you are just limiting the risk. Yeah.
Okay, got it. And when it comes to, let's say, the example of the 100K, when I wanted to create the daughter company in the first place, do I first have to create the daughter company, transfer the 100K, and then switch the ownership to, or flip it around to become the mother company? Or can I just ignore the daughter company and I just create a holding company which now owns the operative company and I transfer the 100K in this direction to get it tax exempt? Which way
Exactly.
do I go?
Exactly. You have several ways. The one way is just to this operative company has 100,000 euros.
Yeah.
You can just say, okay, I am Julian. I have 100% of the shares of this
Hmm.
company A, and I just want to create a company B, which is going to be the holding company. So I can
Okay.
just bring my shares as Julian, 100% of the shares in company A, I bring it into company B,
Yeah.
and I became the only shareholder of company B. So I, Julian, I would have 100% of company B, and company would B would have 100% of company A. That are the shares that I brought into company B. Yeah. So there's a way to do it like this, or you can just say, okay, I'm going just to give a loan and just to tax it with 2% interest rate. This could be
Yeah.
another way to do it. Or I, Julian, I'm going to create a new company, just company B, and then I'm going to keep my shares in company A. So there are like a few strategies that we can do, but usually I recommend if you plan to have many businesses, and
Yeah.
especially if you want to sell one of these business in the future, you really need to have a holding structure. It is super
Yeah.
important because if you have a holding structure and you sell this active company in the future, let's suppose you receive 10 million euros and you back on that time you just created this company for 50,000 euros. So you would have 9 millions, almost 10 million euros, 9,950,000 euros of capital profit. Yeah. And if you hold it as a natural person, me, Julian, I would have to pay 28% capital gain tax. But if the company is held by another company, which is the holding company, when the holding company sells the daughter company, then the taxation is only 1.25% because there's this 95% tax exemption. So this makes a
Okay.
huge difference. So if you plan to sell your business in the future, you really need to structure everything through a holding company. Definitely.
Okay. Okay. Got it. All right. Back again from the sidetrack. I know we got a little bit sidetracked. I blame this on myself. We'll move on to the next question. But I mean, super interesting regarding the holding structures. It's definitely a massive way to save on tax. Hey everyone, thanks for watching the interview. Like I said, this is just the first part of the interview, so click through here or here to watch the second and third parts of the interview. If you thought this was helpful, make sure to like the post, and please, if you're watching this on YouTube, click the subscribe button to stay tuned for more helpful tax content for you and your friends. If you haven't joined the community yet, I'll leave a link in the description for you. Alright, bye bye now.